Hey friends, my name is Sahil and this is my Personal Finance Academy. There's no doubt about the fact that the future is digital. Especially due to COVID, every company has now realized that digital is not just an option but a necessity. Now India has been in a very sweet spot because of its dominance in the world in IT services. There's a huge surge in order books and the future outlook for IT companies is looking very bright. But as an investor, there is one problem. The Indian IT ecosystem is so huge that it doesn't include just one or two companies, but it includes many great companies across your large, mid and small cap category. And it gets very confusing to choose the right company. Now IT companies are not the only companies in this technology space. There are a lot of new age technology based companies that are disrupting the businesses. And this disruption is across sectors. Be it your e-commerce, fintech, insurtech, edutech, telemedicine and so on. Companies are using advanced technologies like IoT, big data, advanced analytics, artificial intelligence, machine learning, cloud computing and so on to transform the way we live. And due to rising usage of smartphone and internet, these new age technology companies are growing at a very fast rate. And this trend would only continue to increase in the future. In fact, even the Indian government has a lot of focus on digitization. One of the most important aspects of technology-based companies is the scale. Today, the internet is available even at the remotest village in India. So people, even from the remotest village, can access the internet and use the services of these new age technology companies. For example, today you don't need to go to a bank to transfer money from one account to another. You can simply transfer funds using mobile apps within a few seconds. Then you can order stuff online, you can study online and the list goes on. So technology provides a huge scale to business. I mean, unlike a physical product like a watch that can be used by only one person, you can make an app that can be downloaded by millions of people. Due to this advantage, these technology-based companies are very asset-light in nature. They don't need to invest millions and billions of dollars in setting up the manufacturing facilities. And hence, they have high margin and high profitability. Interestingly, till last year we had a very few listed pure play technology based companies in India. But now a lot of internet based digital companies are launching their IPOs and many of them are looking promising due to their leadership in the sector and high growth potential. But a majority of them are either loss making because they are burning a lot of cash to gain market leadership or available at ultra high valuation. So it gets very difficult for retail investors to make the right decision. On one side, there is a bright growth prospect and investors do not want to miss the bus, but on the other side, majority of new age internet companies are loss making and available at very high valuation. And that's where I believe that one of the options for retail investors is to opt for mutual fund that invest in the technology sector. Now this gives one more benefit. These technology-based mutual funds nicely spread the investment across your large cap, mid cap and small cap category. So this balances your risk versus return. Then they also keep some exposure in newest digital companies. On top of this, they also have some exposure in top US technology giants. Now before we discuss technology-based mutual funds, please note that we will only discuss the direct plan and growth option of the mutual fund. And the returns, AUM, expense ratio and stock holding is taken as on 7 December 21. I hope you know that the mutual fund returns that you see on various websites changes every day as they are point in time returns. So please do not get confused. And this video is only for educational purpose. Please do your own research before investing your money. And if you want to learn more about mutual funds, stocks, insurance and so on, you can explore my complete course on money management. Alright, let's get started. So number third mutual fund is ICICI Prudential Technology Fund. This fund has the largest AUM in the digital fund category. As of 7 December, this fund has an AUM of 6,886 crore. Its latest expense ratio for direct plan category is 0.77%. Now if you look at the return, this fund was launched in January 2013 and since then it has generated a CAGR return of 27.67%, where its benchmark S&P BSE Tech TRI has generated 15.7% return in the same period. So ICICI Prudential Technology Fund has beaten the benchmark by a very good margin. In last 1 year, this fund has generated a return of 78.95% against the benchmark return of 50.45%. So this fund has consistently beaten the benchmark. If you look at the stock holding, as per latest data, it has 41 stocks in the portfolio with 97.23% equity holding. Out of this, 55.4% exposure is in large cap, 8.93% in mid cap, 18.27% in small cap, and 9.53% holding is in foreign stocks. Its top 5 holding include Infosys with 21.69% holding, TCS with 9.38% holding, HCL with 9.24% holding, Tech Mahindra with 8.87% holding, and Persistent System with 5.82% holding. Although this fund has majority of exposure in Indian IT companies, it also has some exposure in other tech sector companies as well as US tech giants, including IndiaMart, Intermash with 1.75% holding, Microsoft with 1.62% holding, Salesforce with 0.98% holding, and so on. It also includes a very small portion in newest digital companies of India, including Zomato with 0.27% holding and Nykaa with 0.16% holding. Although the percentage contribution of new age internet companies is very small. Number 2 mutual fund is SBI Technology Opportunity Fund. This fund also was established in January 2013 and since then it has generated a CAGR return of 25% in last 9 years. This fund has a latest AUM of 1,890 crore and expense ratio of 0.98%. During the same period, the benchmark return was 15.7%. So this fund has also beaten the benchmark by a good margin. In last 1 year, this fund has generated a return of 70.18% against the benchmark return of 50.45%. If you look at the latest portfolio, this fund has 24 stock in the portfolio with 94.1% in equity. Out of this, 49% in large cap, 7.25% in mid cap, 11.47% in small cap, and 22.7% exposure in US tech companies. So this fund has more exposure in US companies as compared to ICICI Prudential Technology Fund. Its top 5 holding include Infosys with 22.47% holding, Alphabet Inc. with 9.69% holding, HCL with 8.43% holding, Tech Mahindra with 7.11% holding, and TCS with 5.91% holding. Its top foreign holding include Alphabet with 9.69% holding, Microsoft with 5.34% holding, Nvidia with 3.38% holding, and Netflix with 2.35% holding. Again, this fund also includes the new age internet companies like Zomato with 1.82% holding and Nazara Technology with 0.74% holding. Now, number 1 mutual fund is Tata Digital India Fund. This fund was established in January 2016 and its latest AUM is 3,842 crore and its expense ratio is 0.43%, which is the lowest among all 3 funds that we discussed. Since inception, this fund has generated a CAGR return of 27.11% against the benchmark return of 24.98%. In the last 1 year, this fund has generated a return of 80.9% against the benchmark return of 59.9%. So this fund has again beaten the benchmark by a big margin. If you look at the latest portfolio, this fund has got 36 stocks in the portfolio with 91.23% equity holding. Out of this, 58.86% is in large cap, 14.73% in mid cap, 10.1% in small cap, and 4.07% exposure in US tech companies. So this fund has very small exposure in US companies. Its top 5 holding include Infosys with 21.25% allocation, TCS with 12.45% allocation, Tech Mahindra with 9.74% allocation, HCL with 9.15% allocation, and Persistent System with 3.32% allocation. So basically, all 3 funds have similar portfolio of top stocks, but it is all about the percentage allocation in those funds and timing to increase or decrease the allocation based on their valuation. And of course, the expense ratio also plays an important role in overall returns. So lower the expense ratio, better it is. So in this video, we discussed the top 3 technology-based mutual funds. All these 3 mutual funds have beaten their benchmark by a big margin in the past. And considering the fact that technology has a very bright growth prospect, these mutual funds are expected to continue their outperformance in the future. As a retail investor, sometimes it gets very difficult to pick the right IT or technology stock, and that's where these technology-based mutual funds can be a good option to invest in the entire basket of technology stocks in a systematic manner. So if you are a salaried employee and investing every month but do not have enough time for research to pick the right technology stock or confused about the new age internet-based companies, then these technology-based mutual funds can be a good option. But please remember that sector or theme specific mutual funds are more volatile than normal mutual funds. So make sure you understand both the risk versus return aspect of investment, and also ensure that you invest based on your financial goals. Now tell me in the comments, what is your top technology pick and which option do you prefer, individual stocks or mutual funds? I hope you will find the video useful. I'll see you in next video. Till then, take care.